Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Great you can join us as we round out the week, and it looks as though we're trying to push high just at the very end of trade here, as you can see, coming off the bottom about an hour and a half ago where we were in the red. And so we are just pushing, may well end up close to 0.1% higher. That's on the CBO. Also similar moves there on the ASX 200. Now, of course, globally there is the focus still on tariffs, with Australia still likely to be subjected to the 10% tariff rate on all exports to the US, but the government will continue to try and negotiate for an exemption. That is according to the PM, Anthony Albanese, and what he had to say today. A 90-day pause in the US reciprocal tariffs set to expire early next week, and President Trump threatening to send letters to countries laying out the tariff rates they'll face on US imports if they haven't done a deal. Also, we did see iron ore set for a second weekly gain as China pledges to crack down on price wars. Mind you, we have seen the miners come off today after rallying over the past couple of days. Let's just get to the themes of the day. Job strength. Now, that refers to what we've seen out of the States with a much better than expected non-farm payrolls report. And that boosted the share market, but also pushed any chance of a rate cut further out. High denied. Well, that refers to our local market, where we were at the beginning perhaps looking towards setting a new record high, but it is not to be, it would seem. An RBA rate cut, all eyes next week will, of course, be on the, well, what is expected to be another rate cut by the RBA on Tuesday. Let's get across what has made news today. Fairly quiet day. Nonetheless, Santos signing an LNG supply contract with QatarEnergy. Magellan posting net outflows of $200 million for the month of June, while the fund will pay distributions of $500 million in July. And Cleanaway, that's up after the ACCC cleared its $377 million acquisition of Contract Resources. While mining services company Monadelphous, that's also up slightly, having won a new contract worth more than $100 million with Technip Energies, and Capricorn Metals slipping slightly, reporting production of more than 32,000 ounces of gold in the fourth quarter. Let's get across what we are seeing locally and globally, both at a macro level and also for investors. Let's welcome Shane Oliver from AMP. Shane, welcome back. Good to see you. Let's start stateside. We'll get to, of course, we're in the new financial year. We'll get to that in just a moment. But what did you make of the latest read on particularly those US jobs? As I mentioned there, stronger than expected, perhaps pushing the rate cuts further out. And of course, also the big news that Trump finally got his big, beautiful bill across the line.
He certainly did. And obviously he's going to be celebrating that for a while to come. I think the jobs numbers were good, but they weren't fantastic. Yes, the headline number, 147,000 new jobs in June, is better than expected. But if you look at it, a lot of it was public sector jobs. Private sector jobs growth had fallen to around 74,000. So it is looking a lot softer. The unemployment rate did go down, but that was because the participation rate went down. There's less people in the labour force in the workforce looking for jobs. So that could actually be seen as a negative sign. And then when you look at the business surveys, the ISM numbers out this week showed weakness in employment, both for manufacturing and services. We've got the consumer confidence survey last week showing that consumers are perceiving the jobs market to be weakening. So yeah, it's good news for now, and it probably will head off a July cut, or make it even less likely we're going to get a July cut from the Fed. But by the same token, there are still signs there of a slowing in the US economy, which you need to allow for, even though share markets are celebrated. I guess the big question is whether the One Big Beautiful Bill Act, which is now passed Congress, will provide a fiscal stimulus. I think that's very much up in the air. It will probably add to the US budget deficit, but there are some offsets there. We're seeing the tariffs. And as you were referring to just before I came on, the Trump is threatening even higher tariff rates with letters to be sent out to those countries without a deal, which is virtually everybody, bar Vietnam and the UK. is even talking about 60 to 70% tariffs. So you could argue there's a lot more revenue to come through, which will offset the stimulatory impact of the tax cuts in the One Big Beautiful Bill Act. The other aspect is that that One Big Beautiful Bill Act does have tax cuts mainly for high income earners, whereas the spending cuts, the savings, are actually going to hit lower income earners. And we know that high income earners don't change their spending so much, whereas low income earners do. So in a distributional sense, it could have more of a dampening impact on growth. So I think at the end of the day, it's fairly unclear. All we do know is that One Big Beautiful Bill Act will keep the US budget deficit pretty high at around 6 to 7% of GDP, and that means more upwards pressure on US public debt. And in fact, that act actually raises the debt ceiling by $5 trillion. So it's heading off a debt ceiling debacle, which is good news, but it does mean ever higher US public debt.
Yeah, just pushing that debt further into future generations that they've got to cop it. But I mean, often we talk about, look, this is unsustainable, but it goes on, Shane. At what point perhaps will the bond market actually push back?
Well, that's an interesting question, and bond investors have become a bit more twitchy of late. We saw that in the last week in the UK, uncertainty around whether the UK Chancellor, their Treasurer, would stay in place, and whether the fiscal rules that she's set to hopefully reduce the UK budget deficit. Then, of course, the government came in and said, she's going to be there for a while longer. The Prime Minister said that. So the bond vigilantes are still out there, and there is a risk in the US that as investors become less enamored of investing in the US, uncertainty around Donald Trump's erratic policy making and other issues has seen more downwards pressure on the US dollar. If that continues, then it may make it harder for the US government to finance its budget deficit. And just bear in mind, for the last few months, they haven't been issuing new debt because they've been up against that debt ceiling. They've been running down cash reserves to keep the government going. And so now what's going to happen is that the bond issuance will ramp up again. And so it's going to be interesting to see how that pans out, because if global investors prove to be still cautious about investing in the US, maybe the letters on tariffs, another round of tariff wars could add to that uncertainty, and that could make it more difficult. But you are right there. Everyone's been talking about the sky falling with US public debt for years now. The US debt clock on Times Square, I think, was first put there in 1989, a long time ago now, 36 years ago. So, and yet it hasn't blown up. But that doesn't necessarily mean it won't become a problem at some point. It's just very hard to try and time when that might be.
Shane, now, of course, it's round out last financial year, beginning the new one. And I was just looking at your notes saying, look, it has been remarkable, hasn't it, the returns over the past 12 months, particularly when you consider what has happened since Liberation Day and the bounce back in the share market. And you posed that question, are these returns sustainable? What are the factors likely to be at play that will answer that question?
Well, we all know the negatives, and some of them we've just been talking about: the US debt situation, the tariffs, which are likely to flare up again, I think. And you've got a chart there. It's just been a roller coaster ride. We started off at 3% at the beginning of the year, around just after Liberation Day, it pushed up to around 30%, currently averaging around 15%. Lots of legal uncertainties around that, which could upset the whole apple cart. But the sort of thing that Donald Trump's now talking about, 20% on Vietnam, which is hardly a good deal, and potentially other countries paying a lot more, 60, 70%, means the tariff number could go back up again. That could cause uncertainty. We've got signs of some slowing in the US economy. We've got a profit reporting season coming up in the next few weeks, and then later in Australia. So that could trip investors up. We've got seasonal weakness through August, September. So it's quite conceivable, we go through another correction in markets, much like we had in the first half of the year. The flip side, though, and of course the other thing to add into all of that is that shares are expensive. The forward PE on Australian shares is around almost 20 times, US shares around 23 times. The equity risk premium being offered by shares, when you look at the gap between the earnings yield and the bond yield, is very low. So all of these things do imply a degree of vulnerability for markets in the short term. I think it's also the case, if you're a technical analyst, you'd be looking at the RSI, on the US, and it's about as stretched as it's been in a long time on the upside, warning of some pullback. So I think those near-term risks are certainly there. Flip side, though, is that I think that Trump is gradually pivoting towards more market-friendly policies. I think if we do go through another escalation in the tariff wars, then it's quite conceivable that he'll back down again. You'll get another round of taco. Trump chickening out, particularly if the bond market throws a hissy fit and the bond vigilantes are out there again. And we'll see central banks. I think the Fed will start cutting in September. I think Australia will continue to cut. We'll get another cut next week from Australia. Other central banks will cut as well. And all of those things, I think, will support markets over the next 12 months. But it could be a little bit rough over the next 3 months. And you can see in that chart there that we've just put up, there's about 100%, almost 100% probability in the money markets that they'll cut next week. I wouldn't say it's that high. I'd say it's about 80%. There is some chance they could hang in there. But it's almost getting up towards 4 cuts on a 1-year horizon in the money markets out to June next year, March, June next year. So I think those things should actually be good news. Now, obviously, if we trip over into recession, all bets are off. It gets a lot more difficult, but I think we should avoid recession. But investors should just allow that we are going to see more volatility, and it's probably the case that the rates of return we've been seeing from shares, from balanced funds, will slow down a little bit over the next 12 months. We've had 3 years in a row now of 9% plus balanced fund returns. History tells us sooner or later you're going to have a somewhat rougher patch, and I think we probably will see returns slow down a bit over the next 12 months.
Yeah, well, and just on, so what is the risk then, I guess, Shane, if the RBA actually doesn't follow through with its dovish talk and deliver 2 or 3 more rate cuts?
Well, that's a good question, because it's not assured they're going to cut next week. There are reasons why they may not.
Yeah.
They might say unemployment is still low. Share markets are buoyant again. That wasn't the case when they were getting more nervous through April into May. And of course, the house prices are taking off again. So they could say, well, let's wait and see. There's no great hurry. I don't think they'll do that, but that risk is there. And it's interesting to note, as you know, alluded to, that the money markets are saying almost 100% chance of a cut. Economists, I saw a survey from Reuters today of 37 economists surveyed. I think only 6 or 7 were looking for no change at this meeting. So most economists, 30 economists out of 37, would be surprised here. So I guess flip side, though, is that these things happen every so often. I think the RBA would still cut again in August. And I do think the language they used in their last meeting was a lot more dovish, and therefore they are a lot more attuned to the risk to the economic outlook than was the case earlier this year, when they were still more focused on inflation. So I think they will deliver on those extra cuts. But if we don't get them, then I think there's more downside risk to the growth and therefore profit outlook. So that would be the main outcome from that, were that to occur. And obviously that would then entail a risk of higher unemployment.
Shane, great to get a look at the week that was and a look at the year to come. Thanks so much for joining us from AMP. All right, let's now turn to our stock of the day. And we were looking at FY26 buys from our panel, this time looking at US stocks, given that it is Independence Day. Lachlan Hughes joined us from Swell Asset Management. He chose Uber, and Mark Moreland from Value 3, Hims and Hers Health.
It's obviously Mobility Solutions is the one everyone knows, but obviously Uber Eats is the second one. They're the number 2 competitor to DoorDash there in the US, and they're expanding into new verticals, whether it's grocery or courier services. They take the majority of their revenue from outside of North America, so I do like that. And they hold the number 1 position in mobility in most of the markets where they operate. And it's a scale business. The larger you are, the shorter wait times you have, and that's a very good thing for users.
Hims and Hers, and they're a telehealth company in the US. And basically what they're doing is they're trying to disrupt the wasteful and bloated US pharmaceutical and drug delivery business in the US. So their class is telehealth. They're the largest player out of the telehealth operators in the US at the moment, and they've been growing really, really fast. They've got over 2 million subscribers who are getting regular drugs and compounded pharmacy delivered to them every week or month. So, and that's been growing, and it's very, very sticky.
So let's wrap up this Friday with a look at the best and worst in today's trade. Clarity Pharmaceuticals up again today, making a strong comeback over the last month or so. AMP also off the back of a broker upgrade there. Pinnacle, Corporate, Travel and ARB making up the top 5 on the negative side. Taking a look at those, coal miners have been under pressure today, led by New Hope. Also Lottery Corporation are selling there. Also some of the goldies coming off as well. And in the small caps, a quick look. Silk Logistics, as it looks as though it's going to be picked up. It's up 24%, 25%, as looks like it's picked up by DP World. And on the negative side of the small caps, Yogi off 12.5%, Bougainville Copper also coming off, and some of those other resources in the small caps. Checking on what is going on overnight, we get producer prices out of the EU, and of course we do have US markets not trading given the Independence Day holiday. Looking ahead at the week, the focus for us very much on that RBA rate decision on Tuesday. RBNZ also making a rate decision. The federal budget balance out of the US, of course, that is very much in focus, particularly given that Trump's big beautiful bill has now passed. And also locally, we do get a read on household spending from the CBA. All right, so this is where it looks as though we're going to finish up marginally on the CBO 200, almost 0.1% higher, and similar moves there we've seen on the ASX. Looks as though we're up around 1% for the week on the ASX 200. That is the COB for this Friday and for the week. Join us again next week.